The 2-year Treasury Note hits 5%. Last week's $400+ billion of new issue Treasury auctions and the upcoming week's big news that could move the bond market. Hello, members and super savers. I hope you're having a good week. These are the 3 topics that we'll be covering in today's video. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. The 2-year T-note hit 5% again this past week, the second time in 2 weeks, but it still ended just a bit shy of 5% on Friday at 4.96%. The last time the 2-year note closed above 5% was in mid-November of last year. There were 2 pieces of standout news this week in the universe of bonds, both of which were released by the Bureau of Economic Analysis, the BEA. News number 1 was the first quarter 2024 GDP advance estimate, released on Thursday, April 25th, showing that inflation adjusted, or real gross domestic product, increased at an annual rate of 1.6% in the first quarter of 2024. In the fourth quarter of 2023, real GDP had increased 3.4%, meaning that the overall economy is still solid, but growth is slowing, as you can see from this illustration here. This annual rate of 1.6% for the first quarter of 2024, though, it was quite a bit lower than market expectations. What really got the market concerned, though, was that despite the slowing GDP growth, inflation came in higher than anticipated, which lets us seemingly transition into news number 2, which was the Personal Consumption Expenditures Price Index, or PCE, released on Friday, April 26th. PCE is the Fed's favorite inflation measure. Curious minds want to know, why is that the case? And do you know the difference between CPIU and PCE? Drop a comment below and let me know. In any case, PCE came in at 2.7% year over year, and core PCE came in at 2.8% year over year. Core PCE excludes food and energy, which are notoriously volatile. Both PCE and core PCE numbers weren't really showing that inflation was coming down, but on the contrary, that it might even be slightly accelerating again. So, to summarize, the key takeaways from last week's 2 standout pieces of news are: 1. Despite higher rates, the economy has been slowing somewhat, but is still doing fine. And 2, despite higher rates, inflation is still persistent and might even be slightly accelerating again. No surprise then that bond yields trended upwards nicely again last week for bond buyers, as the likelihood of rate cuts appears to be getting pushed out further and further towards the latter part of this year, or even beyond, which is a great segue into the next section of our video. So let's compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. As I mentioned earlier, and as you can see from these green arrows, bond yields trended upwards nicely again last week for bond buyers relative to the week before that, with the exception of the 1-month or 4-week maturity and the 2-year, both of which went down 1 basis point, as indicated by these red arrows here. The 2-month or 8-week maturity stayed pretty much the same, as indicated by this diamond NestEgg yellow horizontal line here. Now, let's get rid of these 1-week-old yields here and compare Treasury yields from this past Friday versus the start of 2024. And here's where they were when we started this year on January 2nd. And in this row is the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black, and decreases in rates are shown in red. And again, we can see that on the very short end, yields are a bit down, but the changes are a few basis points only. So we can say they stayed more or less stable, which makes sense. Remember that the Federal Reserve controls rates on the short end, and they have not raised or lowered rates since their July 2023 meeting. Otherwise, rates have gone noticeably higher overall, especially on the medium and longer maturities, as you can see here. And a final comment about this week's events. There were initial market concerns this past week about whether there would be sufficient demand for the 2-year, 5-year, and 7-year T-notes that were being auctioned off. No surprise given the large auction numbers at stake. $69 billion of 2-year notes, $70 billion of 5-year notes, and $44 billion of 7-year notes. Well, there was sufficient demand. As you can see from these auction results here, pretty solid, especially given the fact that all of these auctions happened one day apart from the other. It seems that our government just keeps issuing more and more debt, and investors just keep buying more and more of that debt, at least for now. So, that was a recap of bond yields and last week's auctions. Now, let's take a look at what's happening this week because, well, it's going to be a very busy week in the world of treasuries. As we can see from Treasury Direct's upcoming auctions page down here, all the weekly T-bill and CMB auctions are happening as usual. Other than that, things are pretty quiet on the auction front. But don't let the silence fool you. Next week is a big week for treasuries and the bond market overall. The first piece of big news, on Monday, April 29th, the Treasury will release its quarterly refunding statement. If you're a bit newer to us and have never heard of the quarterly refunding statement, you should know that in normal times, the quarterly refunding statement is not an event that's really in the limelight, but normal times, these are not, given our growing budget deficit and the heavy government borrowing that's needed to fund that growing budget deficit. The quarterly refunding statement basically walks investors through the Treasury short-term plans for note and bond issuance. So that should be interesting. And in the second piece of big news for our Diamond NestEgg community, on Tuesday, April 30th, the Treasury is expected to announce the May I-bond rate, including the new fixed rate. For those of you who've asked, here is our latest I-bond fixed rate projection tracking sheet. Updated for TIPS real yields as of April 26th. TIPS real yields have also trended upwards overall since we last shared this table with you, and we are still projecting an I-bond fixed rate of 1.3% for May 1st. Let's see if the Treasury gives us a nice surprise in a few days' time on the fixed rate or not. And the third piece of big news for this upcoming week will come on Wednesday, May 1st, when Fed Governor Powell will announce the outcome of the Fed's meeting that may or may not lead to a change in rates. At the current time, the market expectation, as we can see from the CME Fed Watch tool, is that the Fed will keep rates steady. Based on the recent reports of economic growth and stickier than expected inflation, the likelihood of rate cuts appears to be getting pushed out further and further towards the latter part of this year, or potentially even later, as I touched upon briefly towards the beginning of this video. What do you think? Will the Fed cut rates this year or not? Or will they raise rates? And what's your feeling about the economy and inflation right now? Are prices still rising in your area? Drop a comment below and let everyone know. Right, so I hope you enjoyed this video and learned something new. And if you did, I'd love to invite you to take a look at this video here on one of our 2 brand new bond courses so that you can take advantage of some of these anticipated higher for longer rates. And to join us for our next live online bond beginners course session with Q&A on Tuesday, April 30th at 6 p.m. Eastern Time. Check out the links below this video for more details on our bond courses and YouTube Super Saver membership to see which is right for you. Also linked below this video is your 15% course coupon code for April. If you're watching this video when it's first released, there's still a final chance to save on our lowest course prices for this year until 11:59 p.m. Eastern Time on April 30th. Okay, members and super savers, good luck to everyone who's picking up I-bonds, as well as to all of you who are taking a wait and see approach on the fixed rate. And see you again very soon with more brand new wealth building content for your financial journey.